Have you ever been caught off guard by a tweezer's bottom candlestick pattern or other reversal patterns that just didn't work out? You spotted the perfect setup, yet the market turned against you. Frustrating, isn't it? In today's video, we're diving deep into the tweezer's bottom pattern. You'll not only learn how to identify it, but also uncover the common mistakes traders make, strategies to maximize its potential, the psychology behind its formation, and how to integrate them profitably into your strategy for both beginners and advanced traders. By the end of this video, you'll confidently trade this pattern like a pro. Note, this is not a financial advice. It's a strategy I use, and it works for me and all my students when implemented right. Let's dive in. So what is a tweezer bottom candlestick pattern? A tweezer's bottom is a bullish reversal candlestick pattern that forms at the end of a downtrend. It consists of two or more candles. The first candle is a bearish candle indicating selling pressure, and the second candle is a bullish candle of either similar length or smaller body that rejects the same price low as the first candle, signaling buying interest. Think of it like the market testing a floor twice and failing to break it, showing buyers are stepping in to defend that level. What are the characteristics of identifying a tweezer top pattern? 1. Identical lows. The defining feature of a tweezer's bottom pattern is that both candles within the pattern have nearly identical low prices. This occurs when the market tests a specific price level twice but fails to break below it, signaling strong support. The matching lows reflect a clear rejection of lower prices by buyers, as sellers are unable to push the price any further downward. 2. Significant trend before the pattern. The tweezer's bottom must occur after a well-established downtrend to serve as a reversal signal, and not in a ranging market. Prolonged selling often exhausts sellers and creates oversold conditions, increasing the likelihood of a reversal. As retail traders tend to continue selling into the downtrend, but smart money, institutions, begins accumulating positions, setting the stage for a reversal. Number 3. Candlestick size matters. The first candle in the tweezer's bottom pattern is a large bearish candle that signals intense selling pressure. The body of the candle, open to close, should dominate, with minimal upper wick, indicating strong downward momentum during that session. And institutional traders may deliberately allow the price to fall aggressively to accumulate long positions at a discount. Moving on, there are advanced methods for trading the tweezer bottom pattern, which are 1. Alignment with higher timeframe trend. The higher timeframe or overall market trend serves as the market's compass, representing the dominant sentiment. Trading in alignment with this trend increases the reliability of the tweezer bottom as a reversal signal, as you're working with the prevailing market flow rather than against it. If you're trading on H1, analyze the H4 or daily chart. If trading on M15, check H1 or H4. 2. Integration with key zones. Key zones act as magnets for price action and amplify the significance of the tweezer bottom pattern when they align. Support levels. Horizontal levels where price previously reversed. 2. Psychological levels. Round numbers like 1300, 1200, or 150 hold psychological importance and often attract institutional interest. 3. Fibonacci levels. Fibonacci retracements 61.8%, 78.6%, and extensions 127.2% and 61.8% often coincide with reversal zones. 4. Demand zones. Demand zones where institutional buying occurs are prime locations for tweezer bottom patterns. Next, 3. Integration with indicators, such as RSI or MACD. Indicators like RSI and MACD reveal underlying momentum shifts and help filter false tweezer bottom signals. They provide early warnings of trend exhaustion and increase confidence in the reversal. For example, RSI divergence, when price makes lower lows, but RSI makes higher lows. This indicates sellers are losing strength. Secondly, oversold zone. RSI below 30 signals oversold conditions, which align well with the tweezer bottom's reversal premise. 4. Integration with volumes. Volume reflects the intensity of buying and selling activity. A volume spike on the second candle of the tweezer bottom indicates heavy buying pressure and validates the reversal. 5. Integration with liquidity sweep. Liquidity sweeps occur when the market manipulates price to trigger stop-loss orders and trap retail traders before reversing. When tweezer bottom forms after this stop hunt, It makes the pattern more reliable and a prime reversal signal. Liquidity sweeps occur near significant price levels such as swing lows, support zone, psychological levels, and are characterized by specific price action behaviors by breaking below a key level, triggering stop losses, but immediately rebounds above the level. This rejection often forms the second candle of the tweezer bottom pattern. Before we continue, don't forget to subscribe or follow. Next, variations of the tweezer top pattern. The tweezer bottom candlestick pattern has multiple variations that enhance its interpretive depth and effectiveness as a bullish reversal signal, such as when the first candle is a large bearish candlestick and the second candle forms a doji pattern, indicating indecision and reduced selling pressure, a piercing pattern showing buying pressure at the lows, and hammer, signaling strong rejection of lower prices with a long lower wick, or an inside bar pattern, demonstrating a bullish tendency, with each variation reinforcing the overall reversal potential when accompanied by support zones, volume spikes, or alignment with psychological and Fibonacci levels. And finally, confirmation and entry. Confirmation of the tweezer bottom candlestick pattern varies depending on the specific variation, as certain combinations provide immediate bullish signals upon completion, while others require additional candlestick confirmation for higher reliability. The need for confirmation is influenced by the strength of the bullish reversal signal inherent in the second candlestick. Strong reversal candles, such as piercing pattern, hammer candlestick, provide sufficient evidence for entry, while weaker or neutral reversal candles, e.g., doji, inside bar, demand a follow-up candlestick closing above its body to validate the bullish sentiment. For this example, we have a tweezer bottom pattern of a bearish candlestick and a hammer candlestick pattern, which requires no additional confirmation, but can be traded with other confirmation confluence to increase its reliability. So we set a sell limit after its formation and place our stop loss below the support level formed by the tweezer's bottom pattern and target the next resistance for take profit or a 1:2 risk to reward. Let's explore more examples on a live chart. Here on the gold USD 1-hour time frame, the overall market trend is bullish, consistently printing higher highs. Pay attention to this example. So let's mark out our support zone, which have been tested multiple times and where we expect price to react from. However, the market is currently in a bearish movement, approaching our point of interest, POI, which aligns with a key support zone. On closer inspection, as the market reached our POI, it printed a tweezer bottom piercing model, signaling a potential reversal and an opportunity to go long. Now it's time to go in, but if you take a close look, going in right away will make our stop loss too large. So as usual, we set a buy limit 50% of the pattern to reduce risk and place our stop loss few pips below the tweezer bottom pattern. Then target the next resistance zone as take profit. But market went all the way to our take profit without tagging us in, so we missed this trade. And it's okay to miss a trade if it doesn't fall into your risk management plan. Just did this example to show that we miss good trades sometimes, and it's no big deal. Just wait for the next trade and avoid FOMO or chasing trades. Now, let's look at another example. Here on the same gold USD 1-hour time frame, the market is trending upwards, consistently forming higher highs. We identify our POI, a support zone, tested multiple times where we anticipate price might react, and wait. Market started trending downwards and printed a bearish momentum, candlestick and stick. As the price reaches our zone, it forms a tweezer bottom candlestick pattern signaling an opportunity to go long. But on closer analysis, market formed a higher high, but when we shift our focus to the RSI indicator, it formed a lower high. This divergence between price action and the RSI signals potential weakness in the downtrend and giving an opportunity to go long. RSI divergence, combined with the formation of a tweezer bottom and support zone tested multiple times, provided additional confluence. So we set a limit 50% of the pattern in order to reduce risk ratio, though I could enter immediately as the stop loss would not be too large. We place our stop loss below the pattern and target the next resistance for take profit or a 1:2 risk to reward. We managed our open positions accordingly, and eventually take profit was reached. By combining patterns, indicators, zones, and careful trade management, we can create high-probability setups with minimized risk. That's it, traders. Tweezer top and tweezer bottom patterns can be a game changer when used correctly. Remember, practice is key, so spend time backtesting this strategy and applying it to your demo account before going live. Remember, these patterns are just one piece of the puzzle. Successful trading requires discipline, risk management, and continuous learning. If you enjoyed this deep dive, make sure to like, subscribe, and share this video with your trading community. Let me know in the comment section what topic you would want us to cover next. From DMFX Trading School, happy trading!